Welcome to the Loan Doctor podcast. This is where we turn home buyers into home owners with condominiums. Why is it different than buying a single family detached home?
There is an element where the lender is approving the project that is completely separate from approving the borrower.
Does it make a difference if the condo project is FHA approved?
When a condo is warrantable, the only thing that warrantable means is that it meets the guidelines set by the secondary market, whichever secondary market happens to be the one that is being used.
So you say that the gentleman who owns 70% of the building basically controls the HOA.
So from a developer standpoint, if he's selling his units, because he's selling his units and his intention is to sell it to a point where he has less than 20% ownership, you're allowed to buy the unit from the developer.
Why is it that HOAs went up so much?
What happened in Surfside was a tragedy, and I think that sometimes when we have a tragedy, there tends to be an overcorrection.
Now, in today's market, is it a good time to buy a condo?
And if you're thinking about buying in condo, you're making a good decision there too, and I think you're going to find it a little bit more affordable in the coming years.
If you had to have a crystal ball, where do you think condo projects will be in 3 to 5 years?
What'll happen in 3 to 5 years is condominiums will be considered a stable investment.
What is the biggest challenge in getting a condo project approved by the bank?
Tell me if you're aware of any structural problems with your building, and you tell me. I'm not going to tell you if I'm aware of it or not.
With condominiums, is there a specific portfolio loan just for condominiums?
Getting approved for a condo is easy when you know what you're doing.
Welcome to the Loan Doctor podcast, and this is where we turn home buyers into home owners. Richard Brandt. Got a couple of questions for you today. I want to focus on condominiums.
Okay.
And the reason I want to do that is even though we do mortgages in all 50 states, I think in the state of Florida, where we are local right now, there are so many condo buys and challenges at the same time. Okay, because we kind of broke the rules in every single way, and we also tried to fix them quickly. And that's kind of the issue with condominiums here when we focus on different areas of FHA or HOA and warrantable and non-warrantable and so many things that have to do with condominiums. So to start with condominiums, why is it different than buying a single family detached home?
Yeah, that's a great question. And what happens with condominiums, and condominiums are everywhere, right? Not just Florida, but they're all over, and they have different challenges and things like that. But what happens with condominiums when it comes to mortgage financing, there is an element where the lender is approving the project that is completely separate from approving the borrower, right? That the purchaser, if it's a refinance, the owner. And that's really where it gets tricky because those two things are happening completely independently. The borrower, right, the homeowner, or the buyer is getting approved and going through all their process of us looking at their finances, looking at their credit, their collateral, and in some cases, or their capital, and in some cases their collateral. But the condominium part is completely independent of that. And when a lender is evaluating a condo project, the lender wants to make sure that the project is healthy because that not only protects the consumer, but it also protects the bank and the bank's investment.
So how does the HOA tie into everything you just said? Because I know that that's also one of the big challenges when it comes to condominiums.
Well, so a condominium is run similar to a business, right? It's a not-for-profit entity, and they make sometimes good financial decisions, and sometimes they make bad financial decisions. And so when a condominium is being evaluated, there are several things that the lender is looking at. And again, I stress that when the lender is looking at it, yeah, the lender is protecting their position, but they're also protecting the consumer. They want to make sure that the consumer knows exactly what they're getting into. And I'll kind of go into the different things that we're looking at. It starts by doing a condo questionnaire where we ask the condo about what their usage is like, how many people are living in it as opposed to investors, what's the ratio of people paying their monthly dues on time, right? Because a condominium had their expenses are somewhat fixed, regardless of how many people might be paying or how many people might be living there. A lot of their expenses are fixed. So if you have 15 or 20% of the people that are living in the community not paying the HOA bills, well, somebody's going to have to step up and fix it. And usually it's the owners who are paying, right?
I see what you're saying. Now, does it make a difference if the condo project is FHA approved?
Well, so FHA approved or Fannie Mae approved or anything is really talks about condominiums in a sort of a different sense. So primarily in the United States, we have really four secondary markets or three secondary markets. We have Fannie Mae, Freddie Mac, and Ginnie Mae. Ginnie Mae is for FHA and VA, and then Fannie Mae and Freddie Mac. And so what happens in the finance world is most loans are either sold to the secondary market or they follow the guidelines set by the secondary market. And when it comes to condominiums, that's really the sort of the end all be all in determining how a condo is positioned in terms of its financeability, right? So we use a term, and I don't want to use I don't want to use technical terms, but this is the term, and for lack of a better word. So when a condo is warrantable, the only thing that warrantable means is that it meets the guidelines set by the secondary market, whichever secondary market happens to be the one that is being used.
What is secondary market?
So the secondary market are those things that is the Fannie Mae, Freddie Mac, and Ginnie Mae.
It means it could be sold.
It means that it means it has the potential to be sold even if it's not going to be sold. What happens is if you go back to like how banks make money and stuff like that, is if a bank only lent based on its deposits, eventually it would not have the ability to do mortgages because it would run out of money at some point, logically speaking. So what a bank does is a bank sells a percentage of their portfolio. Some banks sell a lot of their percentage. Some banks sell a small percentage, and then a lot of times they're selling it to the secondary market, to Ginnie Mae, Fannie Mae, or Freddie Mac. And so these secondary market sources are the determining factors for what bucket a condominium project might fit in. Okay, so going back to that warrantable term, and all warrantable means is that the project would be eligible for financing by Ginnie Mae, by Fannie Mae, or Freddie Mac. So Ginnie Mae is FHA, Fannie Mae, Freddie Mac is that. So it just means that the project is financeable. And the project meets a certain small set of criteria, a very, very specific set of criteria. And the truth is, most condominiums meet that criteria. There's also two different sets of criteria that happens when you're talking about a condo. The type of financing that you can get for a condominium is also influenced by how much of a down payment you're putting. So somebody putting 5% down, the condo has to meet different requirements than somebody who's putting 25 or 30% down.
And does it make a difference if the unit is full of owners, people that actually purchased and are living there as opposed to just all rental properties? Does it also make a difference on that?
Yeah, yeah, that's one of the things that we're looking at is the owner concentration or the investor concentration. How many units are occupied as investments? How many second home? How many are being used as a primary? That influences the type of financing that might be available. One of the things that happens because your usage also dictates that, and I don't know. I want to try to make this specific, but it's somewhat hard. When you're buying it into a condo, for you, the consumer, here are the things that matter. Thing number one that matters is how are you going to use the property? Is it going to be your primary residence? Is it going to be a second home, or is it going to be an investment property? And how much money are you going to put down? Okay. When we know those factors, then we're able to evaluate the condominium project based on those variables. Okay. When we're looking at a condo, we talked about the fact that we're looking to see is are the people making their payments?
Yeah, because if somebody, well, let's say 15% of the building is not making their payments, I would assume that the HOA not only just goes up because, like you said, they have to supplement that, but then doesn't that also factor into the approval of a mortgage?
Yeah, if a good percentage of people aren't paying their bills, we want to look at why. The other thing that we want to talk about, we look at investor concentration, how many units are owned by investors. The another factor that is also considered is a single owner concentration. So if you have a single owner who owns more than 20% of a project, it automatically goes from being potentially warrantable to being non-warrantable.
Why is that?
Well, I think what happens is when you have a one owner who has a lot of concentration, is that they're able to dictate to a certain extent some of the things that can happen in the association. And from a risk assessment, I don't think the bank likes that position. And also protecting you. We've had a situation where this came up not that long ago, where a single owner owned like 70% of a condominium, and he turned it into apartments, and everybody was forced to sell.
The other 30% had to sell?
Yep. Yeah, yeah. Because he controlled the HOA.
So you say that the gentleman who owns 70% of the building basically controls the HOA,
Yeah.
and that doesn't seem fair, but also it doesn't seem fair if the builder is still in control of the HOA. How does that work?
Yeah, it's a little bit of a different factor when the developer controls the HOA. So when you have like a new project, one of the things that happens when you go back to that 20% rule, and in lending we always have these if then moments, right? And so what happens with the single owner concentration is if the single owner is actually the one selling the units and he is selling more of his units that are for sale so that he gets below the 20% threshold, the fact that one single owner has 20% then doesn't matter. So from a developer standpoint, if he's selling his units, because he's selling his units and his intention is to sell it to a point where he has less than 20% ownership, you're allowed to buy the unit from the developer.
So a lot of people decided to move to Florida and get a condominium. First of all, why would you want to live in a condo as opposed to a single family? I mean, I know why because I'm from sunny Miami, but for the rest of the country, what are the kind of reasons that they give you?
Well, I think condominiums have its advantages. I think that in terms of cost, you probably get maybe more square footage for the dollar, or you definitely might get some better amenities depending on where the project is and things like that. I also think sometimes people like being around other people. Uh, it's also it's easier to leave. So if it's a second home or something like that, it's much easier to close up, and you don't have to worry about the outside maintenance and things like that. So I think there's a number of reasons why somebody would choose a condo, um, as opposed to like a single family house or a townhouse, despite some of the challenges that come with financing it.
Well, I find that it's a country club lifestyle, almost like a hotel. You have your pool on one floor, you have your gym on another. Maybe you have stores, which, by the way, that's mixed use, right?
Yep, yep.
And with that, does it make a difference if the bottom floor, let's say, are all full of businesses and restaurants and the rest of it is residential? Does it make a difference for mortgage purposes and getting
Yeah.
approved?
So for mortgage purposes, you can have a certain percentage of the property be mixed use or be used for commercial, depending on the different loan programs that are out there. Having commercial stuff on site isn't going to bar you from being financeable.
Okay. Now, I know that a lot of people heard the news years ago when, sadly for our community, Surfside had the devastation that it did. But
Yeah,
because of Surfside, we've had a lot of rules, regulations, and laws changed.
yeah,
And that led to HOA rising, and a lot of people couldn't keep their apartments or condos. And a lot of others have challenges in getting approved for a mortgage. Why is it that HOAs went up so much?
Well, I think a couple of things happened with Surfside. What happened in Surfside was a tragedy, and I think that sometimes when we have a tragedy, there tends to be an overcorrection. Right, wrong, or indifferent. I'm not judging it.
Hmm.
It is what it is. And one of the things that happened out of that from a lending perspective is lenders now are asking for condominiums to tell us about their structure. You know, have they done a structural integrity report? Have they, what kind of things are they aware of that says that the condo, that they might have some kind of deferred maintenance? And it's funny too, because a lot of times we send out a condo questionnaire, and the condo questionnaire has some questions that are specific to structure. And a lot of property managers put like NA on it. And NA is akin to you telling me, asking you, hey, tell me if you're aware of any structural problems with your building. And you tell me, I'm not going to tell you if I'm aware of it or not.
Right, because NA essentially is not available.
Right,
Like
right.
information is not available.
Right. But the fact of the matter is if you run the property, if you're managing the property, you either are aware that something's wrong or you're not, right? So telling me giving us a response that says I'm not going to tell you if there is or isn't acceptable, right? And from a consumer standpoint, even though the lender is protecting itself and people might get frustrated by it, we're really protecting the consumer. Because if you're going into buying that project and they're aware of structural defects, significant structural defects like that caused the Surfside collapse, wouldn't you as the owner want to know, like, how could you not tell me this information? And for them to give us a reply that says, we're not going to tell you. We're not going to tell you if there is or isn't. I'm just not going to tell you. Not applicable, just kind of doesn't fly. And it's a big challenge, especially in Florida, only because there's no there's no really great legislation that holds condominium projects accountable to sort of how they answer the questions for the lenders. It's
Still, there's none.
no, it's really really tough. It's part of what makes buying a condominium a little bit of a challenge because the bank needs to connect all the dots. They need to figure it out, right? And again, I can't stress enough that they do this for the consumer. As much as they're protecting their investment, this is done for the protection of the consumer because you don't want to buy into a condo that isn't run well, that where they don't have adequate reserves, they don't have a plan if something were to break. They don't that they have significant deferred maintenance where they're just waiting for something to fall apart, right? Who wants to buy into a condominium project? Kind of like, again, we talk about it like, who wants to invest in a business where the business is losing a ton of money? Who wants to invest in a condo that's just being run really, really poorly? You don't. And so the bank's mission is to really kind of get all that information and to make sure the condo is being run adequately. We have a lot of condos in Florida, and it is important to understand how how the condo project impacts the ability to get a loan on that particular project, right? And it's not glamorous, it's not sexy to talk about and everything like that, but it is kind of, having an understanding makes it a little bit easier to overcome the obstacle because condos do have advantages that over their single family or townhouse counterparts.
Well, I was going to say, on insurance,
Yeah.
isn't it a better or easier way to get insured? Because
Oh,
that's an issue that we have for single family homes.
yeah.
Getting just home insurance because of hurricanes and whatever else in this particular state. But with condominiums, it seems like it's a bit easier.
There's a trade-off with insurance when it comes to a condominium. Your insurance is a little bit cheaper because the HOA or the condo association is covering everything from the walls out. So that you only need to get what's called an HO6 policy or a walls in policy. So your insurance premium is a little bit better, but you also have a higher HOA to pay for some of that exterior.
Something else that I understand to be higher is interest rates for condominiums are a little bit higher. Why is that?
Sometimes that's a product of down payment. So, but the interest rate for a condominium could be a little bit higher. Uh, Yeah, to be honest, I think that's above my pay grade. There are these actuaries that kind of assess risk. And we talk about banks are really just investors. They're investing in you, right? And so there are these actuaries that kind of set risks. And so they look at condominiums as being a slightly more risky investment, especially at the lower down payment. And so because of that, they apply a cost to it.
Is there a difference between a condominium building that is 4 stories or less and one that is, let's say, 4 to 10 stories?
Well, there's certainly a difference in how they get evaluated to a certain extent. I think that now, with everything that happened with Surfside and things like that, condos have to get structural integrity reports, and people are more serious about those 40-year and 50-year inspections and things. The trick with when you're financing a condo and getting involved in a condo project is determining if there is deferred maintenance or routine maintenance. You know, significant deferred maintenance, significant deferred problems, present a problem from a financing standpoint.
You're saying if the elevator hasn't been serviced, if the parking lot hasn't been done in many years.
No, that would be sort of routine maintenance, but I'm saying like if parts of the balcony are falling off, that would be,
That could be a little dangerous.
yeah, that would be kind of that would be somewhat significant. If it was an unsafe environment in certain areas, that would be somewhat significant. And so that is definitely going to impact the type of financing that's available.
Now, from a lender standpoint, do you prefer people that come to you for condos or single family or townhouses? Is there a preference there?
Wow, that no, I think that some lenders avoid condominiums and some buyers avoid condominiums because of the things that we talk about. But I think if you understand the process and understand what goes into the evaluation, it becomes a lot easier, and it's not as intimidating. And so to me it's what's ever best for the client. And they kind of know. I think the struggle is just kind of getting people to sort of understand that there's a couple extra steps that we have to go through, and it has nothing to do with you as a consumer. It has nothing to do with you as a consumer or your ability. It's just about protecting the collateral, which is also yours because the equity is yours.
I know that the bank has said no to projects and
Mhm.
yes to the borrower.
Yep.
So do you suggest that the borrower go to another building, or how do you handle that? Because they've been pre-approved. They're great. It's the project itself that's not great.
Yeah, we've had situations like that. And so when you're buying into a condominium, right, the down payment is a factor. How you're using it is a factor, like we kind of talked about. And so when we're evaluating a project, going back to what I was saying before about warrantable, warrantable, that rule that says that if you buy a condominium and it meets the guidelines for Fannie Mae, Freddie Mac, or Ginnie Mae, that it's warrantable. Non-warrantable is the way that you would describe a condo that is every other condo, right? So warrantable is a very specific set of circumstances which are good. And even if it's not warrantable, it doesn't mean the project is bad. It just means it doesn't meet the specific set of criteria. The specific set of criteria isn't the end all be all. So then you have this non-warrantable bucket, which is every other possibility, right? Now, some non-warrantable condos could be bad, right? Some non-warrantable condos, the reason for them not fitting in that small little category is extreme and dangerous, and we don't want to get involved in it. And then some of it is just a different way of looking at accounting, right? I mean, I'm kind of making it similar and kind of making it simple, but it's a small little thing. And I'll give you actually a really specific example. In order to meet the specific set of criteria, a roof has to be insured for the actual replacement cost.
Okay.
Okay. So if I have a 20-year-old roof, I have to insure that roof for the actual replacement cost in order to fit into this warrantable bucket.
Hmm.
Okay. But if I'm a condo project that knows I have to replace the roof, I've been saving money to replace the roof, right? And I've got, whatever, $3 million for the roof to be replaced the moment it gets to a point where it has to be replaced, right? Then I'm going to insure it for the actual cost. And because I don't care. I know I have to replace the roof. I'm not looking for the insurance company to pay for it. So when the roof goes, we'll get reimbursed for whatever the roof is worth, and then we'll pay the difference because we knew we had to anyway. That doesn't make the condo being that doesn't indicate that the condo is run poorly. They just made a financial decision that actually makes economic sense, but it doesn't fit into this little bucket,
Okay.
right? Because the bucket is fixed. The bucket doesn't care.
But not all lenders will take care of non-warrantable condos.
No, not all lenders will insure a non-warrantable condo. And when it comes to non-warrantable condos, not all lenders will look at a non-warrantable condo the same way. Some lenders will tolerate a little bit of deferred maintenance, and some lenders won't tolerate any, right? So because that non-warrantable bucket is so big, it's really hard to, once you kind of get into there, it really takes a lender who kind of understands condominiums.
And how do you work with an assessment? Does somebody buying the project pay for it? Does the previous seller pay for it? Do they negotiate that? If there's a $50,000 assessment on a condo,
Yeah,
what happens?
so it depends. I mean the condo assessments are really it's when you're selling a condo, right? Condo assessments are really part of what's negotiated. So if you're a seller, you might say that I'll pay the you pay this price and I'll pay the condo assessment. Or what you might negotiate between the buyer is I'll pay it up to this day and you pay it up from the after that. You know, I think part of it is, it varies. I mean, most of the time you see that the seller pays it, but every now and then you'll see it where the buyer's going to pay whatever the difference is.
And are closing costs the same or similar for a condo project as
Yeah.
opposed to townhouse or single
Yeah,
family?
the closing costs are similar. The only closing cost that is different is that condo questionnaire, that can range anywhere from $250 to $500.
But they still do the other stuff, the appraisal and they
Yeah.
don't do a survey.
Well, no, we don't have to do a survey, but we do have to do an appraisal and all the other stuff, title searches and everything that goes along with buying a property, buying real estate. It's all going to be there. So that there isn't a significant cost advantage to buying a condo in terms of closing cost than buying a single family home or a townhouse.
Now, in today's market, is it a good time to buy a condo?
Yeah, I think so. I know a lot of times, especially right now, and especially in Florida, if we're going to talk, specifically to one area, there are a lot of condominiums that are being hit with assessments, and people's dues are going up drastically. And part of that has to do with how condos were run before and how legislation has changed. So the new legislation has required the condominiums to actually be balanced, right? They didn't used to have to be that. And so now they have a different standard. And so what happens with associations is they've been having to make up for the fact that they weren't collecting enough in the years past. So they've had to make up for that this year. And then on top of that, they also had to make up for the fact that next year they want to make sure that they don't fall into the same hole that they had this year. So they have to increase it for next year. So essentially, everybody who is in a condominium is getting double dipped for this year and probably into next year. I think what's going to happen, at least in the Florida market, is in about 2 years, you're going to find that HOA dues are going to start to come down because they're going to get a handle on this budget thing that kind of got out of hand, in Florida. And it might be happening in other parts of the country, but it's definitely more prevalent here.
So what you're saying is if you have one, just try to write it. Just keep going. It's
Uh,
going to get better
yeah,
as far as the HOA.
I think the condo market is definitely going to get better. I mean,
Yeah.
they generally say condos don't appreciate the same way that a single family house does or a townhouse does, but they do go up in value and things like that. And so if you're in a condo now and you're frustrated, I do think sticking it out is okay.
Yeah.
And if you're thinking about buying in a condo, I think that's you're making a good decision there too. And I think you're going to find it a little bit more affordable in the coming years.
Now, I know that you personally also do uh, work with foreign nationals, something that a lot of banks won't do.
Hmm.
Do foreign nationals have a different set of criteria when buying condominiums, which is a great investment here and makes it easy for them not to have to live here and still own it?
Yeah. So the criteria for a condo isn't any different. So they're obviously as a foreign national, they're qualifying from their side, right? As the borrower, they're qualifying from in a little different way than an American consumer or permanent resident. Um, but the project itself is evaluated the same way. That project evaluation is completely independent of anything that has to do with the consumer other than how it relates to down payment and use.
If you had to have a crystal ball,
Mhm.
where do you think condo projects will be in 3 to 5 years?
Well, I mean, I think that what'll happen in 3 to 5 years is condominiums will be considered a stable investment. Right now, specifically to Florida, it's not, but I do expect that to change. I do think it's a little bit cyclical. Um, One thing I would like to touch on too is if you have a condo now and you have a big assessment coming up, one of the things that you might want to do is tap into the equity in your condo and use that to help pay the assessment. It might be a little bit easier to manage.
Okay, is that something similar to a refinance?
I mean, you could do it as a refinance or an equity loan. An equity loan is really about leveraging some of the equity that you have in your property and using that for other sources. I had this wasn't a condo, but this happened just yesterday. Actually, I got a call from somebody who wanted to do a refinance, lower his monthly payments, and we were going to save him about $200 a month,
Mm.
which was not bad. It was a $300,000 loan. Saving $200 a month isn't bad. But one of the things that I told him was that if I gave you cash out, I could still save you $100 a month, and I would give you enough money to replace the windows so that you have all impact windows, which will decrease your insurance by $2,000
And keep you safer.
and keep you safer, make your house a little bit more valuable and stuff like that. So I'll save you $100, and then on top of that, you'll save another 150 or $200 on insurance.
Hmm.
And he really loved that idea.
Okay, so the idea is going back to
Yeah,
like the assessment, fifty
that
thousand
wasn't really about a
dollars.
condo.
No, but it can be.
Yeah,
So you have a $50,000 assessment,
yeah,
and you're scratching your head. How do I pay this now? I mean, I wasn't expecting this, and I didn't know I was going to have to pay 50,000
correct.
because of the new laws.
Yeah, yeah.
And you don't have to tap out. Don't be afraid. You still have equity in your condominium. You can get a refinance or a different type of loan,
Yeah.
right?
So there are ways, yeah. If you're in a condominium and you find that you're having difficulty affording it with the new assessment and stuff like that, there are things that could be done to mitigate that and make it easier and move it back to being affordable for you without you having to sell it.
Now we see condominiums up for sale and selling
Hmm.
left and right
Yep.
because people love them.
Yeah.
Is there a difference whether it's on the beach or if it's way out west? Does it make a difference from a lender's point of view?
No, not really. It really is about the economics and about the projects, how well the project is run and organized, how the property manager is doing, how the homeowners are the homeowners association is or the condo association is taking care of the project and doing the things that need to get done. Yeah, location isn't a big factor.
What is the biggest challenge in getting a condo project approved by the bank?
The biggest challenge we kind of touched on is getting the answers to the condo questionnaire.
Really?
Yeah, we want to know. Yeah, because so many projects
Don't want to answer the
don't
questions.
want to answer the questions. I,
Right.
I think what happens is they fear like there's some kind of liability that they're going to have, right?
Mhm.
And I go back to the structural thing just because it's a real big issue that it shouldn't be an issue. If I'm a property manager, right, I either know that there's an issue or I'm not aware of an issue. There's only two choices. There can't be a third choice that, right? There is no other third choice. I'm either aware of an issue or I'm not aware of an issue, right? And so the property manager telling me I'm not aware of any issues, and then there's actually an issue, doesn't make the property manager liable, unless it's negligence and she should have been aware.
Unless it's documented that they did know and they just lied.
Right, exactly right. If you're telling me that there's no issues, but when you go to step before the front door, there's a big hole in the driveway in the walkway. Well, then you should have known, right? So if you're doing your job diligently, you should be aware of any problems. And if you are aware of the problems, just tell us what they are. And so why it's a struggle for that to happen is very difficult. And then there are other things that make it a little bit more challenged. Like one of the things that we want to know about a condo project is if they're being sued, right? So you as a consumer, I'm about to buy into this property. They're getting sued by somebody. I would want to know, is the suit a big deal? Is it a potential issue that could cost us millions of dollars that the insurance company isn't going to cover? That's going to cause my HOA dues to go up? I don't know.
So if they had some type of litigation in the last year,
Yeah.
if it's a small amount, you can overlook it. But if it's a large amount being put on them, you want to know all the details.
Well, I think you want to know all the details regardless, right? Because the only way that you know if it's a small amount or a large amount is if you know the details. And
Like if there was an issue with the pool and somebody
yeah,
slipped and fell
so
terribly.
just because a condominium might be being sued doesn't make it a bad risk. It's just a matter of let's assess it, let's know what the situation is so that we're aware of it, and then we can decide is it a good idea or is it a bad idea, right? If a condominium has a $10 billion lawsuit against it, probably not a good idea, especially if their insurance company's not going to pay. But if it's a slip and fall or somebody got hurt or
Which happens every day.
happens all the time and something negligible, the insurance is going to cover it or whatever. It's not going to impact whether the project is financeable or how it's financeable. We just need to know. And that's the struggle, is getting the answers to the questions that we need to know and understanding the importance of that information.
And I know that, we obviously want people to go from home buyers to homeowners, and we're here to do that mortgage for you. But from a realtor point of view, should they pursue the condominium projects? Should they pursue that as a sale?
That's a great question. I know real estate agents that actually avoid condominiums. And I will say this, as a real estate agent, if you have the opportunity to list a condominium, you absolutely should do that. You should absolutely list a condominium if you have the opportunity to do so. Now, I say that because education is really the key. And what you should know going in is, if I'm going to list a condo, I want to know what my financing options are, right? So if I'm going to list a condo for sale, I want to know what are the types of buyers that I can get. And the way that I can do that is by having my condo evaluated for me as the seller instead of for me as the buyer. Because when you're the seller of a condo, number one, you're part of the HOA. Some of those things that I talk about in terms of having difficulty getting answers to that question, you're entitled to those answers. You're an owner, right? It'd be like a member of the board of directors not getting an answer about how the company is doing.
If the bank has an issue getting those answers, the owner has the right to go and knock on the condominium HOA's door and say, I would like these answers.
Well, the owner has, in terms of practicality, right? Because they're supposed to answer the questions, but in terms of practicality, the owner has the best ability to affect change. And so what we do at the Brandt lending team is we actually are set up to help condominium owners sell their condominium, because what we'll do is we'll go through the evaluation process. And when we talk about condos that are warrantable, right, we will talk about, if we say the condo is warrantable, it's warrantable for everybody. So it doesn't matter if we had determined that the project is warrantable, the buyer for that particular condo could go to any lender and get a loan, and they're going to fall into that same bucket. We just did the evaluation and we're happy to share it and pass it along. If the project is non-warrantable, then there's some nuance because you have to find a lender that will either insure it or will allow you to lend on it or they won't, right? And so, but we'd be able to make that determination that says, hey, not only can somebody buy this condo, but somebody could buy this condo with 5% down or 10% down, or maybe they have to put 20% down, or we would tell you the only offers that you could take are cash because nobody's going to finance this project.
Now, I know that the Brandt lending team works with a lot of portfolio loans, which just means a variety, right? Because your story is different than mine. Mine is different than hers or his. So, with condominiums, is there a specific portfolio loan just for condominiums? Or is there a choice? Is there a variety? If my story is different than my neighbor's, how do you get people approved differently?
Getting approved for a condo is easy when you know what you're doing. We had a situation, right? I think last month we closed on a condo. Another lender couldn't do it. We were able to close on it. Everything went fine. I think it took us from start to finish like 2 weeks, and everything went fine, even though this other lender couldn't do the job. And part of that is not because we had a different set of rules, just we understand the rules better. And it's so important to find the right company when and even more so when you're buying a condominium.
That's what I think too, because I've seen you get phone calls from realtors that are at their wits' end. And I say that because they've tried everything possible to get an approval because obviously everybody needs to, pay their roof over their own heads and they can't do it. And then they come to you and you get it done. And sometimes, like you said, in less than 15 days, sometimes it'll be 30 days, but you get it done. So why is it that you can do that and they can't?
I'll say it again, buying a condominium doesn't have to be intimidating as long as if you're getting financing, as long as you have the right lender. If you have the Brandt lending team, you're in good hands. I'm sure there are other lenders that are capable too. But we understand, not only do we understand at the Brandt lending team, but North Point Bank has an excellent condo department. And so because of that, condos don't have to be intimidating when you have the right resource. I think we've talked on the importance of sort of knowing your lane, right? Everybody it's I can't remember what that saying is, like somebody who's does like a bunch of different things but doesn't really do anything great.
So I know the slogan that you're talking about. It's something where I don't know if it's a teacher of something and a master of none, or
Yeah,
I forgot what the actual slogan is. I'm sure in the comment section, we're going to get a bunch of people
right,
responding with the correct terminology.
right.
And that's great because we need it. But essentially, you're saying you can't be a Coca-Cola in the desert, which is a Spanish slogan. Una Coca-Cola en el desierto for everyone.
Right. No, the trick is that when you're buying a condominium, you definitely want, as part of your finance team, you want somebody who understands condo projects really well. And you don't have to understand them well as long as you have somebody on your team. I think Henry Ford once said that I'm paraphrasing a little bit, but he didn't have to know everything because he had a button on his desk. And every time he pushed the button, there was an answer to whatever question was being asked, right? And so when it comes to buying a condo, you don't have to know everything about buying a condo. Just know that the Brandt lending team is the button on your desk so that you know that you can, if buying a condo is the right project for you, here's how we're going to make it happen.
Oh, I like the way you just said that because you do make it easy. Just call. I always call you though,
Yeah,
personally,
yeah.
which is something else that I love about the Brandt lending team is that you do give your actual office desk number. You actually sometimes do call right from your cell phone and they could call you back. It's not one of those banks where you're lost in space trying to reach a human being. You get people's first name basis. That's how contacts are done with emails and with text messages. It's one to one.
This is For most of the transactions, this is one of the most important purchases of somebody's life. Or the property is the most important asset in their life and stuff like that. And so always remembering that and valuing that is kind of been the secret to our success.
So one last question about condominiums, and this actually has to do with me because
Right,
I purchased a townhouse.
right.
Does my townhouse fall into the condo bucket or does it fall into the single family home bucket?
All right. That's a great question. And the way that you determine whether a townhouse is considered a condominium as well is based on their association. If the townhouse project has an HOA, they're a homeowners association and none of the condo rules apply. And if the bylaws are written for a condo association, then it would fall into the condo bucket. And a lot of times, what people don't realize, it has nothing to do with how the project looks on the outside. So, a lot of times, people will see a townhouse community and assume it's a townhouse, assume it's run like a townhouse. But it might be governed like a condo association. And that's sort of the determining factor is how the association is governed. Do they follow the HOA laws or do they follow the condo laws?
Okay, that makes sense. That answers my question personally.
Yeah. No, absolutely, and it's important to know, especially when you're buying them, because I know that the MLS and those services don't do an excellent job of making that distinction.
Well, it makes a
Um,
difference just on, we were talking about the outside. Okay, well, if it needs painting, is it my responsibility or is it their responsibility? Something as simple as that does determine whether it's condo or HOA.
it can. I actually had we just financed somebody now who had a townhouse and had an HOA, and his HOA actually did cover the walls out.
Hmm.
So yeah, it can happen. I mean, the insurance pays a big part on it. You do kind of figure that if it's a condo association, the HOA is probably going to be a little bit higher, and the insurance is going to be a little bit cheaper.
Does it change the taxes?
No, it shouldn't change the property taxes. Yeah,
The taxes for a condo are relatively the same as they would be for a house?
yeah. The tax rate doesn't change, so it's just a matter of the assessed value.
Okay, so if anybody's looking to buy a condo, they could always call you because, like you said, you do warrantable and non-warrantable. And whether they're an investor, if they are self-employed, because you do work with self-employed borrowers, and I know that that's a different set of challenges, right? Whether they're a foreign national or just somebody who wants some great advice because they're looking to buy their first property. They could always call you. You here are the loan doctor. Your name is Richard Brandt, Brandt Lending Team. And I really appreciate you dedicating so much time to us because I know personally that I could really use this information.
Well, thank you, and thank you for being in my waiting room.